Let's talk about what's happening in the Treasury market. The yield curve keeps coming up again and again. The reality check from Bob Sinche.
Well, I learned a lot about the yield curve situation right now when I used to watch Sesame Street with my kids. Which one of these does not look like the other? And if you look at measures of monetary policy, you look at the yield curve, it would tell you policy is very tight. You look at the real Fed funds rate, it would tell you policy is still very easy. It's about zero. If you look at the leading indicators, they're accelerating. If you look at current growth measures, they're accelerating. So you look around and say, okay, well, why would the yield curve be giving you this different signal? We've had some changes to pension regulations. We have a lot of foreign money coming home based on the new tax bill. That has, in our view, created a major bid at the long end of the yield curve to lock in pension liabilities longer term. So yep. I look at the difference and I say, is there a reason to explain one or the other? And we think there's a very good reason to explain between the pension bid and what's happening to the accumulation of assets that are already on the Fed's balance sheet and the ECB and the BOJ continuing to buy longer-dated government assets. There's a lot of reasons for us to doubt that the yield curve is sending us an accurate signal. I'm a little nervous that the Fed, in fact, keeps harping on it. I wish they'd sort of get into the details a little bit more and address this issue of why we think the yield curve is, in fact, not giving us a reliable indication.
Why do you think they are finding it so scary? When you look at the 30-year today, where it trades right now is where the 10-year was a week ago. That is going to be of some concern to the Federal Reserve that things are getting a little bit too flat. Why aren't they coming out and saying those things? Well, it's different this time. Do you think they're scared to say it's different this time?
My colleague Carmen Reinhardt from years ago would scold them for saying it's different this time. But I think that the Fed's always looking at what could go wrong with the current set of conditions.
Yeah.
And the current set of conditions are pretty good. Inflation's, moving higher, the unemployment rate's down, growth is picking up. So they've got to be worried about what policy errors could come down the road. And clearly, I think now their worry is that we're in the process of normalizing policy. Are we going too far, too fast? And so that makes them nervous. And so what do they look at? They look at an indicator which would tell them that maybe we are moving too fast.